Hi and welcome to this session. We are going to talk about capital structure. Capital structure deals with the question of whether and how the way a firm finances its assets affects its value. In this video, I'm going to talk a bit about Modigliani and Miller theorem on the irrelevance of capital structure, highlight some important misconceptions related to capital structure decisions, and provide you with a qualitative framework to analyze optimal capital structure for firms in practice. This is an interesting plot illustrating the idea behind Modigliani and Miller theorem. They are saying that in perfect markets, which means in a world where there is no taxes, no bankruptcy costs, no transaction costs, no conflicts of interest between different stakeholders, and no need financial flexibility, the cost of capital and hence the firm value is irrelevant to the capital structure of the firm. As you see in this graph, the cost of debt is lower than the cost of equity, and when the firm has zero leverage, the cost of capital is equal to the cost of equity. As leverage goes up, there is more weight on debt, which is the cheaper source of financing. But as you see, the cost of equity goes up with leverage. The increase in the cost of equity completely cancels out the decrease in financing cost that comes from using more debt, so that the cost of capital overall stays constant. Note that at very high levels of debt, the claims of debt holders also become riskier as the company increases its leverage, and hence both the cost of debt and the cost of equity goes up. In any case, the important message of Modigliani and Miller is that we should never think or argue that if one source of capital, namely debt, is cheaper, by using more of it, we will manage to reduce our cost of capital. More than 60 years since Modigliani and Miller showed this powerful result, for which they were awarded Nobel Prize, and after decades of teaching this idea to our students, still one of the biggest misconceptions in finance is due to failing to understand Modigliani and Miller theorem. Specifically, it is frequently argued that since the cost of debt is less than the cost of equity, increasing leverage reduces the cost of capital. This is a fallacy and is exactly what Modigliani and Miller wanted to show that it is not true. Whatever risk you have in the business, it will be there regardless of the mix of financing you are using. When you use more of the senior and hence cheaper source of financing, you pay less for that part, but the claims of others, in this case shareholders, become riskier, and hence they will expect you to deliver more return to them. Overall, the risk will stay constant, but distributed differently to different claim holders in the company. It is important to highlight that typically in reality, as companies increase leverage, say from 0 to 5%, the cost of capital does go down. But that has nothing to do with the fact that the cost of debt is cheaper than the cost of equity. Instead, it is due to the fact that in most parts of the world, interest payments are tax deductible. In other words, the payments to shareholders that come via dividends, for example, will be taxed, while the payments to debt holders that shows up in interest are tax deductible. This different treatment is obviously favoring debt financing. It is this effect that sometimes reduces the cost of capital as leverage goes up, and not the fact that the cost of debt is lower than the cost of equity. The second important fallacy that you will very often hear is that companies should not borrow money, since borrowing money lowers the net income due to interest payments. This argument misses the fact that when you fund a bigger portion of the assets with debt, It effectively means that you are repurchasing shares and hence you will have lower shares outstanding. As a result, indeed, you will have lower total equity value but also lower number of shares. So what are the most important assumptions in Modigliani Miller? The first is that the tax rate is zero, which means that even if interest payments are tax deductible, there will be no benefits for debt financing, since the tax rate is zero. So if you relax this assumption and otherwise keep the word of Modigliani Miller, the optimal financing policy would be to finance the company with as much debt as possible, say 99.9% in leverage. So you must think that this also cannot be true in reality. There must be some downside to having too much debt, and indeed there is. The biggest one is the cost of bankruptcy. These could be direct costs that has to be paid if the company gets to bankruptcy, such as the cost of filing for bankruptcy, paying for lawyers, and so on. These are in fact a small portion of the total bankruptcy cost, and this direct cost for a typical company has been estimated in some studies to be around 5% of the total firm value. In other words, 5% of the firm value will be lost because of this bankruptcy cost. The largest cost related to bankruptcy is what we call indirect cost of bankruptcy. These are the costs that the company bears before even getting to actual bankruptcy. When companies start to become stressed due to high levels of debt, and there is a concern that the company may go bankrupt in near future, the company starts to lose its customers, suppliers will be reluctant to serve them, their skilled employees start to look for other jobs and leave the company. The company fails to recruit new talents and so on. All these create huge costs for the company, which can by itself forces the company to bankruptcy due to huge loss of income from these indirect bankruptcy costs. These indirect bankruptcy costs have been estimated to be around 25 to 30 to 40% of the total firm value for a typical company. Of course, depending on the firm and the industry, the firm may have a much higher bankruptcy cost. For example, loss of customers would be most relevant for companies that they sell more durable products and the customers need the support for several years after the purchase. For example, the producers of cars and machineries will lose much more customers than a supermarket when they are in distress. Also, companies that typically sell their product way in advance, like airlines that customers book the flight several months ahead, will be more likely to lose more of their customers. Who wants to book his honeymoon trip with an airline that could go bankrupt in a few months and then cancels the flight? One other important aspect you need to pay attention to is the companies that their most important and valuable asset is their skilled employees, like most of the tech companies. Unlike traditional manufacturing companies, these companies could easily lose huge amount of their assets, which are their employees, as soon as they get to distress. As you know, employees, unlike machineries, are mobile, and since slavery is not allowed in most of the modern world, debt holders or equity holders will not be able to get those employees as compensation for their claims. So all in all, companies with high amount of intangible assets will have extremely high amount of bankruptcy costs. The assumption of no financial constraint is also something that does not hold in reality. Companies do face financial constraints and cannot always and easily raise money to fund their investments. As a result, in the real world, financial flexibility or running the firm in a conservative way with low leverage and a relatively high amount of cash could have a large value. Of Of course, this applies particularly to those firms and in those industries where having financial flexibility matters a lot. For example, companies whose cash flow are not stable and could change dramatically due to some macro shocks or as a result of changing customer tastes and so on should value financial flexibility more. In addition, growth companies and those that have unpredictable financing needs should also attach a high value to financial flexibility and hence run their firm in a conservative way. Of course, due to transaction costs of issuing debt and equity, some companies may sometimes prefer one source over the other or do not quickly adjust their capital structure since it may be costly for them to do so. All these are telling us that there are trade-offs when deciding to have higher or lower leverage, which leads us to the most popular framework to analyze capital structure decisions. This is called the trade-off theory. The framework suggests that the optimal capital structure is determined by the magnitudes of the benefits and costs of debt for each particular company. As mentioned before, the largest benefit of debt is that the interest payments are tax deductible, or it is the interest tax shield. The largest cost associated to having leverage is its bankruptcy cost. This is the most basic form of trade-off theory and can be used to analyze and predict what the optimal capital structure should look like for different firms depending on the magnitude of these benefits and the cost for the firm. For example, if you have a young money-losing company, what should be the optimal capital structure? Well, the tax shield benefits are not so important since the company does not earn any profits anyways. The bankruptcy costs are very high since the company does not have any cash flow and could easily end up in bankruptcy. The value of financial flexibility for them is very high since they need investments and to grow. Then this is very simple. These companies should have zero or almost zero leverage. What about a company that is mature, it has established brand name, earning stable cash flows, and the demand for its product is relatively stable, and it's not a high-tech company where the assets are essentially the employees? Think of this as, for example, Coca-Cola. Without checking the financial statement, you should expect not to see extremely low leverage for this company, because the tax shield benefits for the company is high. The bankruptcy costs are not huge and the need for financial flexibility is not very high. There are also some additional costs and benefits of debt you could consider. In particular, higher or lower amounts of debt could help fixing some of the conflicts of interest between different stakeholders. Specifically, sometimes when managers have too much free cash flow and very few obligations and commitments, they start to do things with the cash that ultimately benefits themselves at the cost of the company's shareholders. Examples of this is when the manager starts to use the cash for unnecessary items such as buying private jets, building new headquarters, and so on. This issue arises because of the conflicts of interest between the managers and the shareholders. In other words, managers do not act at the best interest of the shareholders. In these situations, increasing debt burden for the company could help fixing this issue by disciplining the manager, since they have to run the firm in a way that they can meet their commitments in interest payments. Otherwise, the firm will be bankrupt, which is not something that the managers themselves would like to see. This is also one way that LBOs are supposed to create value in firms with large free cash flows, with large and stable free cash flows. By putting high amounts of debt on the company, the managers will be forced to run the company as efficiently as possible. Having said that, in some situations, having more debt creates a conflict of interest between shareholders and debt holders. For example, When a company has a lot of debt, equity holders might have incentives to follow very risky projects with negative NPV value in the company, since equity holders will have limited liability, but the upside all goes to them. Also, when the firm has a lot of debt and obligations to pay, even if it has some good investment opportunities, new investors might not be willing to fund those investments, since part of the return will have to be used to pay down previous debt holders. This is called the debt overhang issue. The takeaway is that there are different costs and benefits to debt, and the importance and magnitude of those costs and benefits varies across companies and industries. Therefore, the starting point for analyzing optimal capital structure for a firm should be to think of the importance of these forces for the firm that could help to understand whether you would expect a firm to have relatively high or low leverage. And remember that by low we mean around 0% market leverage, and by high we typically are talking about 25 to 40% or something like that. And we are always looking at the market leverage, which means that debt over debt plus equity, where equity at least is in market values, not the book values. This plot illustrates the idea behind the trade-off theory, showing that at very low levels of leverage, the benefits of debt outweigh its cost, and hence, as leverage goes up, the firm value goes up. After some point, which is the optimal leverage ratio, the cost of debt goes beyond its benefits, and hence the value of the firm declines with leverage. This picture illustrates the idea that how the cost and benefits of debt changes through the life cycle of the firm. It is very interesting, and I suggest you to go and read each of them, but it gives you a good understanding of how the things are across the life cycle. And of course, it doesn't apply to every single firm. It's a general way to think about it. First case, when you are in the startup phase, the tax benefits is zero because you are losing money. The added discipline that can come from the debt is not much because the owners are the managers of the firm. So the managers and shareholders' interests are aligned at that stage. The bankruptcy costs are very high since firms have no or negative earnings. The agency cost here, which means the conflicts of interest between shareholders and debt holders, is very high, as firm has almost no assets, in fact, in place. The need for financial flexibility is very high, as firms looks for ways to establish itself, its business model, and so on. Therefore, the net trade-off in terms of the benefits versus cost of the debt is that the cost exceeds the benefits, and therefore the firm needs to have the minimum amount of debt possible. As the company grows, goes through the rapid expansion, high growth, mature, and in decline, you see how overall these costs and benefits develop, which means that as the company becomes mature, the debt becomes a more favorable choice of financing. It should be highlighted that there are also different measures of debt burden, with each measure serving a different purpose. Broadly speaking, these measures can either look at debt as a percentage of total capital invested in business, or look at debt payments due relative to earnings and cash flows of the company. The first becomes an input into the cost of capital, and the latter becomes a measure of the buffer against downturns and crises, and is used as one of the most important inputs when rating the companies. To the extent that having cash on your balance sheet offsets some of the debt burden, you may compute all of these measures using net debt ratio, where cash is netted out against total debt, and net interest expenses, where interest income from cash is netted out from interest expenses. Note that the two approaches measuring debt can give different signals. Thus, a company can have a low debt ratio as a percentage of capital in either book value or market value terms, an indicator of a low debt burden, while having dangerously low interest coverage ratio and high debt as a multiple of EBITDA. So the highest debt burden happens when the company has high level of debt over debt plus equity, has a high level of debt over its cash flow, the revenues of the company is not predictable, and the interest coverage ratio, which is the interest payment over its EBIT, is also very low. So in that case, the debt burden is very high. And you can go to the other extreme where the leverage ratio itself is low, the debt over EBITDA is low, revenues are very predictable, interest coverage ratios are very high. In that situations, which is the other extreme, you have the lowest danger from debt, and as you can see, it varies in between. So what do CFOs tell us when we ask them about important factors in their mind that determine capital structure decisions? When we ask CFOs about the factors that affect their decision to issue debt, this is the distribution of the answers. As you can see, the CFO's ranking of the top 3 factors affecting capital structure decisions are financial flexibility, credit ratings, and earnings volatility, all of which are consistent with the view that debt decisions are influenced by a desire to avoid getting the firm into distress. This does suggest a concern to avoid bankruptcy costs or financial distress costs. When issuing equity, the CFOs are concerned about earnings per share dilution and the recent stock price appreciation. There is this popular argument that when companies issue stock, the value per share goes down since the number of shares goes up. Is that the correct reasoning? No. When the company issues stock, it will receive money from those who buy the stock. The ultimate effect of value per share depends on at which price they are issuing the shares. If the issue price is fair, there should not be any change in the stock price or the value per share. Even when there is no change in price, note that earnings per share will decrease since the number of shares go down. But this has nothing to do with changes in value. The opposite side of this argument is that if funds are obtained by issuing debt, since the number of shares remain constant, the earnings per share most likely go up, and hence this is great for shareholders. However, note that in this case the equity is levered and therefore more risky, so Modigliani Miller again remind us not to get fooled. The stock price should not increase due to higher earnings per share when companies issue more debt. Finally, when CFOs are asked whether they have a target ratio, most of them answer that indeed they have a target ratio, but that target is not very strict. Thanks a lot for watching, and I wish you a great day.